want to make sure that we're able to get everybody on and everybody can hear us. Good, good, good. I see that. That's great. Thank you so much. So we have Stephanie here online, and she's from Colorado. She is a leading firm in Colorado for tax and business for, if you have a small business, medium-sized business, she really is the person to go. Just to so you know, I am the founder of Startup Buffet, and we are a small business library, video library. Basically, we all have the same goals, just to help small business and entrepreneur like you guys. My history with Stephanie is we've been going way back for about 10 years. And I have to say something about this. If you are serious about building wealth and, your journey, you need to have a tax advisor. A lot of people thought, you know what, I don't need a tax advisor right now. The reason is I don't have anything. And that is the silliest thought I've ever heard of. The reason is two reasons. One is, first, if you do not have anything, this is the right time to do it. You do not want to get into trouble after, say, if you haven't have anything asset-wise, that you acquire assets, this is the time to do it, because planning it, getting it right the first time is a lot cheaper than you have to fix it later. That's how it should be done. And Stephanie and her firm can help you guys set it up, get your tax planning right, get your asset protection right, so you don't have to get that fixed later and get it correct. Is that correct, Stephanie? That's the wrong way to do it, is to correct it later. So yeah. Second is, So second reason I believe that people need to have somebody like Stephanie is, if you have a good tax advisor, they can give you the right advice, so you can get ahead. I believe a lot of people, they do not get ahead because they're paying way too much on their taxes. Okay, and for example, if you can just simply save $10,000 a year in your taxes, and what you can do with that $10,000, say you just invest it and just grow 5% a year, and in 10 years, you can accumulate an extra $148,000. Can anybody use the extra $148,000? I can. I raised my hand immediately. So 10 years ago when I first, met Stephanie and, get to do business with her firm, 10 plus years ago, in fact, my husband and I have nothing. We have one income, and we have a bunch of debt. Honest to God, she can tell you that. But today, I'm very, 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 very happy to say we have multiple income streams from different businesses and investment, and that puts us in a much, much better position just because we got her guidance and help us lead us into a much better wealth building journey. So I hope, we all can get there and we keep moving forward. So I'm going to turn it to Stephanie right now, and she can make the presentation, and I'm sure this is very, very beneficial. This will be a great presentation for everybody. Okay, Stephanie, it's all yours.
All right, and let's just make sure everybody can hear me as well. So if a couple of you can just type that you can hear me in the chat box. Okay, great. All right. Sounds great. Okay, good. All right, so I think a lot of you who are listening in know about me and know who I am. I know there are people here on the webinar that have not worked with either myself or the law firm before. And thank you, Ameda, for that very nice introduction. This is just a little bit about me. I have been practicing law primarily as a tax and business attorney. I'm going into my 15th year of practice now. And I started out right out of law school primarily doing IRS controversy type work, and evolved from there into dealing more with business owners and real estate investors as well. So a lot of you know that Scott Essel, my law partner, he started out as a senior trial attorney with the IRS when he first started his practice as well. So we have a lot of experience dealing with business owners, real estate investors, dealing with the IRS, and assisting our clients, making sure that their tax deductions are legal, but also that the clients are maximizing their tax deductions in the best way possible so that they're not overpaying on their taxes. And that's really kind of what today is going to be about on some of these strategies for your business. So, with that being said, taxes are the single largest expense that you're generally ever going to pay in your lifetime. And so for some of you, you could be facing, 40 or 50% of your income that's going to taxes. And so that obviously is a huge expense, and you're not going to really see that expense going to housing or medical expenses or really anywhere else. And so we want to be aware of what we're spending our money on and how we can maximize the different tax deductions that are available so that we're never paying the government a penny more than we need to. Also, as we do this presentation, feel free, if something's not clear, if you want to ask a question, I guess before we get really into this, go ahead and ask questions in the chat box. I'll do my best to answer any questions that come up. If there's something that I won't have time to elaborate on, or something that I don't have time to get to, then shoot me an email after the presentation is over, and I'll be sure to answer the questions later on. But I will try to answer questions as we go, just because if one of you has a question, I'm assuming I have a question. So feel free to ask questions as we go along here. But again, taxes are such a large expense. And again, we want to be doing everything that we can to maximize all the legal tax deductions that are available to you. So when we're talking today about having a home-based business, we're talking about, a lot of you on the call today, you already have a business set up. So you may have a real estate business, you may have a service type business. But if you don't have a business and you're thinking about setting up a business, there are many tax deductions that can apply to what you're doing. And so we actually encourage the vast majority of the people that come to our firm for assistance to have a business in some respects. So, if somebody comes to my office and they want to do tax planning and they come in and they say, well, I have my spouse and I, we just have W-2 jobs where we're employees. And, we, of course, have our mortgage, and we get a mortgage interest deduction and some property tax and charity. We have a couple kids, and that's about it. They're really, because if they don't have a business, they're going to really lose out on really the best tax deductions that are out there. So the best tax deductions that are there are really only available to business owners. And so it's really hard for us if somebody comes to our firm and they want us to do tax planning for them. It's really difficult for us to do any kind of tax planning unless that person has a business or is willing to set up a business. So, of course, I think most of you today have a business in some respect, whether, again, it's real estate or something else. But if you don't, then we want to be thinking about whether or not, if there's a way to incorporate a business into your overall structure to see if we can save some money on some tax dollars there. Okay, so the next question that we need to look at is, if you're looking at setting up a business, what constitutes a legitimate business in the IRS's eyes. So, you can't just go set something up solely for the purpose of taking tax deductions with really no legitimate business purpose. So if you get audited and the IRS is looking at the types of business deductions that you're taking, and if they're making the argument that your business is not, a legitimate business, they might be saying, well, it's a hobby, then you're going to run into issues with them. So you want to make sure that you're keeping good records as far as what you're doing. The main thing is that you have to be sure that you're running your business with an intent to make a profit. You don't actually have to make a profit, but if 10 years goes by and you're running your business with a loss after 10 years, rest assured that the IRS at some point will probably want to look at your business and audit that company, and they're going to closely examine what you're doing, because generally no business owner is going to run their business for 10 years straight and lose money. No legitimate business owner anyway. So again, when you're looking at setting these things up, you can have a loss for the first couple years or so, but after you get past year 3, the IRS, if they audit you, they're really going to closely examine what you're doing, and the burden is always on you to prove to the IRS that you're in it to make a profit. Okay, so again, lots of businesses lose money upfront, and a couple years in, they still lose money, but you've got to have a plan to make a profit eventually. And the longer that you go without making a profit, the more we have to look at whether or not you actually have a legitimate business and whether or not you're going to be allowed to take those tax deductions. So, keep good records. When we run audits for clients that may get pulled and the IRS is questioning the business and saying maybe it's a hobby, we want to make sure that that client has good business records. Having a business plan is a really great idea. Having a separate bank account where you're running your business like a business with separate books and records is a great idea. Keeping your mileage log for your business vehicle, travel log if you're trying to write off deductions for your traveling, things like that are going to become really important, especially if your business is losing money. So if your business is losing money, you're going to be at a high risk for an audit if you're running a loss on your tax return. So it becomes even more important for you to keep really good books and records because of the higher audit risk. So a couple questions here. Is it acceptable to keep a 90-day test mileage log? So those of you who are taking tax deductions for your automobile expenses, which anybody who is living in and who has a business, I'm hopefully all of you are taking a deduction for your automobile expenses, but you are required to keep a mileage log for your automobile expenses. If you get audited, one of the things that the IRS loves to audit are your automobile expenses because they know that the taxpayers aren't very good about keeping records. So they pull that category for audit quite frequently. So you do need to keep a mileage log. The mileage log is going to show the beginning and ending odometer readings to give you the total miles for the year. And then it's also going to have a reading for, where you're going day to day for business. So you need to track, hey, I went to the post office, 1 mile to the post office, and then from the post office, I went to the office supply store, another mile. You need to be keeping track daily where you're going for business. You can keep what's called a 90-day sample where you would keep track of your mileage just for the first 90 days of the year versus tracking it for the whole year. I actually don't recommend that method just because I found that for most people, the mileage isn't really consistent throughout the year. And so you could be shorting yourself if you just keep the 90-day sampling versus keeping the whole year. But of course, that's up to you. The IRS will allow the sample method if you do want to keep the 90-day log versus the 365-day log. So I think that answers that question. But again, I'd really get in the habit of keeping it all year round because, again, you could be shorting yourself. QuickBooks, Excel spreadsheets, those are all fine for keeping good books and records. We recommend to our clients that if they are running a business, that they have a separate bookkeeping system, especially if your business is, has any kind of complexity to it. The program of choice is QuickBooks. At least from my perspective. You don't have to use that, but it's the program that most bookkeepers and accountants are familiar with. And I've had some clients use some other things like Xero and Peachtree and some other types of accounting programs. And, at the firm, my philosophy is if I can work with it and my client is used to it, I'm not going to force them to switch and use something that I want them to use. But if the client is just starting out and they're asking for a recommendation on a program, QuickBooks is definitely the way to go. Again, you don't have to use it. You can use an Excel spreadsheet or something else, really just something that works for you. But if you do want to invest in a good program, QuickBooks is the way to go. So, okay. And then there is a question about what if you use your vehicle for 95% of business? I'm not sure what the question is there, but you can only deduct the business portion of the vehicle. So if you're only using it 95% for business, then you can deduct 95% of it. We're going to get into a little bit later about how you deduct the car. There's a couple different ways that you can go about making a tax deduction there. So we'll talk about that a little bit later. So again, wasn't 100% clear on the question, but again, you can only deduct the business portion and you can't deduct the personal part. Okay, so we'll start out with talking about the home office. Anything that we're going to talk about today as far as the different tax deductions, those are going to be available to you whether you run an LLC, whether you run a corporation, whether you run a partnership, or whether you're running a sole proprietorship or what we call a single member LLC. So these tax deductions apply across the board. Generally, if you can deduct something in an S corporation, you can deduct it in an LLC or a partnership. So just keep in mind. There might be a couple different ways to document things, but the tax deductions that we'll talk about are available to all the different types of structures that you have. So the home office deduction, it's not a red flag. So many people right now are working out of their house that the IRS really doesn't question it. I still have clients come in this day, new clients, and we talk about getting them a home office deduction, and they say, well, my accountant told me it was a red flag. I don't want to do it. So I'm still doing audits on a regular basis, and I don't even remember the last time that they even carefully looked at the home office. So it's not something that is going to trigger an audit or be a flag on your return any longer, just because, again, there's so many people that work out of the house. So we want to make sure that you're incorporating that tax planning deduction if you are not already doing this. There are a couple tests. So if you meet these requirements, you can go ahead and take the home office deduction. So the first part of the test says that you have to have regular use of the home office, which just means on a consistent basis. So you can't be using the office once per year. I usually tell my clients, weekly. A lot of my clients are using their office obviously every day, but weekly, would be good. You could use it probably monthly, and that's okay too. But make sure you're using it on a consistent basis and not just a couple times a year. And then the second part of the test is a little bit more important, because that is means that you have to use it exclusively for business, which means 100%. So every once in a while I have someone come in and say, well, I have, I use my dining room table and I do all my books and everything on the dining room table. Well, that's not going to meet exclusive use, because you're also eating dinner on the dining room table, most likely, right? So you've got to have a space generally that you're using 100% for business. You can't have anything else being used. So if you have a separate room, make sure that you don't have your child's playroom in there or your workout stuff in there, that the room that you have is just going to be used 100% for business and nothing else. Because if you get questioned and if you're in an audit and you tell the IRS, oh yeah, I have a desk in there, but I also have my treadmill in there, you're going to lose the deduction. So just make sure that you're using it 100% for business. And let's see, we had a couple of questions. We're going to talk about the vehicles in a little bit. What do they look at in an audit? Well, most of the things that we're actually going to talk about today regarding the meals and entertainment and the auto, those are kind of what we call the high ticket audit items. So the IRS loves to audit the automobile deduction. They love to audit the meal and entertainment and the travel. And the reason why is because they know that there is more abuse in those areas, and so with the mileage deduction, for example, if they know that a lot of people aren't keeping the mileage log, and so they know that they can, make adjustments there. So I would say that the travel, meals, entertainment, auto, those are kind of high ticket items. But there's some other things that will flag a return for an audit. We're not going to get too much into it today, but anything unusual on your return. Again, if you're running a business with a big loss, that's going to flag your return. So anything that's out of the statistical average can flag the return for an audit. This is really where you want to work with a knowledgeable tax preparer, because they can help you avoid some of these flags. They can, some of my clients, they have taken some things on their tax returns that we want them to take, but if I think it's going to be a flag, I'll just make sure that my client is keeping a really good set of books and records just in case they get audited. So some things you're going to go ahead and do, you just want to be prepared just in case. Okay, and so these are some of the things that you would be able to deduct in relation to your home office. So there's a list here. And you can see there's lots of things on this list. So these are things that you'd be paying for and we're turning it into a tax deduction for business purposes. So your interest, taxes, insurance, all your utility bills, house cleaning, HOAs. I mean, we've got some other things that we could even have on this list that don't show up, repairs and maintenance. So you want to make sure that you're incorporating all of those household expenses. And then in this case, we have a home office percentage of about 21%. And the way that you calculate the home office percentage is you just take the total square feet of the office, divide it by the total square feet of your house, and that's your percentage. And then you can see there on the right that that's your tax deduction for the year. So at the bottom, we've got, roughly about a $5,000 deduction there for the home office. That can easily save you $2,000 to $3,000 every year in taxes just for one type of deduction. And so it's a great strategy to utilize if you're not currently doing it. For those of you who are running a business entity, like a corporation or an LLC tax as a corporation or a partnership, the way that you take the home office deduction, you can still do it. You're just going to do it a little bit differently. You're going to use what we call a reimbursement method for taking this deduction, where the company will reimburse you for the home office expense. And you can just have the reimbursement done. If you want to do it, at the end of the year, that's fine. You could do it on December 31st. And so if you decided that the deduction is $5,000, you just have the company write you a check back from the business account to you personally for $5,000, and then it shows up on the business P&L as an expense to the business. You don't have to pick it up as income because it's a reimbursement. Company gets a deduction. And even better, when you're running a business entity, which we encourage everybody to do, you don't even have to fill out that home office form, that form 8829 that everybody thinks is a red flag. It just shows up as a line item as your other deduction on your business taxes. So IRS isn't even really going to know that's a home office. So if you're worried about it, using a business entity to take that deduction is a good idea. You can do it if you're running a sole proprietorship, obviously, or what we call a single member LLC. It's just you're going to have to fill out that form 8829, and attach it to the tax return. So let's see. Couple of questions. Does it need to be an enclosed room, or can it be a desk and cabinets within a room? It doesn't have to be an enclosed room, but I would recommend that you have some kind of a section where you can kind of section it off to calculate what the square feet are, because otherwise I'm not sure how you would calculate what that is. So if there's some, you could put like a border or something where you can kind of show how you calculated the square feet, that would be ideal. Let's talk about the depreciation deduction on the bottom there. If you go and sell the house later, you may have what we call depreciation recapture, because you have taken a portion of the house and taken a tax deduction for depreciation. My clients that are using the reimbursement method through the LLC or the corporation, we don't actually do the reimbursement for depreciation at all. So you would totally escape having to do the depreciation recapture if you're using a separate business entity. If you're using a single member LLC that files a Schedule C, or you're using a sole proprietor, then you do have to calculate depreciation. And when you go and sell the house, you may have some depreciation recapture. I've never seen that tax be really significant, so I wouldn't worry too much about it. Most of our clients aren't running sole proprietors or single member LLCs because we don't encourage that anyway. So, this probably doesn't apply to a lot of you, but if you are running one of those structures, give me a call. We should definitely talk about doing some planning to see if having a separate entity makes sense for you. Okay, and so in the prior scenario, as I said, you could save $2,000 to $3,000 per year in taxes just using the home office deduction. So in the prior scenario with all those different deductions, we've got a tax savings of $3,064 per year. So I think that's pretty straightforward. So everybody go out, take a room, turn it into a home office. You guys all should be doing that. We start adding up all these things. They may not seem like that much, but when you start adding up these $3,000 deductions in 10 places, you've just saved $30,000. So every little bit helps. Okay, let me just see if there's any other questions I want to address here. We've got a lot coming in. include a basement. I wouldn't probably include the basement unless it is finished. Okay, so if you're going to calculate the total square feet of the house, you could include the basement as long as it's finished. If it's unfinished, I'd probably leave that out. Best method of measurement to maximize or for maximum square feet of the office. Well, again, you're just going to use the square feet method. So if the room is 10 by 10, it's going to be 100 square feet. And if the whole house is 2,000 square feet, then the percentage is going to be 5%. Again, I would just use the finished space on that. What do I think of the different tax preparation programs like TurboTax? I'm not really going to comment on that because obviously we do tax preparation at our firm. And, if you're running anything beyond a W-2 and what we call a Schedule A for itemized deductions, I just feel like if you're using a tax accounting program and doing it yourself without a tax background, you're going to get yourself into trouble. I do a lot of tax reviews, and a large percentage of the time I'm going to catch mistakes and things like that. So if you're running two businesses in the same office, you're still just going to get one office deduction because you've just got one space. But if you and your husband are running a business and each of you have an office, you can include both offices. So if one office is 10% of the house and the second office is 15% of the house, you now have a 25% deduction. So, okay, so let's talk a little bit about the automobile expenses. There are two different ways to calculate your automobile deduction. There is what we call a standard mileage method, which is a little bit of an easier method to track. And then there's the actual expense method. So the standard mileage method, you just would add up your business miles driven for the year. You multiply it times the mileage rate, and that's your tax deduction. So you don't have to actually keep track in that method of any of your out-of-pocket expenses for things like gas and insurance and the car payment. It's all kind of factored in there. So for 2015, the mileage rate was 57.5 cents per mile. So again, if you drove, 10,000 miles for business, you just multiply that by 57.5, and your tax deduction for the year is $5,750. You don't depreciate the car. Everything is generally encompassed in there. There are a couple things that are not included in the standard mileage rate, like parking and tolls, vehicle interest, and vehicle registration, but everything else is already factored into that mileage rate. If you have an older car, the mileage method usually is going to work better for an older car or a car that is not like one of those big SUVs that's going to be costing a lot with the gas prices and things like that. So I would say that the standard mileage method, if you're going to compare the two, you can definitely use that as the easier method for a car that you've had for a while or maybe a smaller car. If you are buying a brand new car and you want to take the special tax deduction for larger automobiles, which we will talk about in a few minutes, or you've got a car that, you spend a lot of money on gas, then you may want to actually use the actual expense method where you are keeping track of all of your out-of-pocket expenses like gas and insurance and all of that, because it may come out to be better. If you're not sure which way is going to come out to be the better tax prepare, run it both ways for you, because one certainly may be better than other. So here's an example of a car that costs $35,000 new, and you're driving it 19,222 business miles. You've got your personal miles, and so the business use here is 63% as far as the business miles driven. Here are all the expenses that have been incurred for the year: gas, insurance, repairs, maintenance, car washes. And so with the actual expense deduction, we have a deduction of almost $12,000. And then we have depreciation. The actual expenses are almost $12,000 with the business percentage of 63%. That equates to about a $7,500 deduction. We include the first year's depreciation, and now we've got a tax deduction with the actual expenses of about $9,300. But then we've calculated the standard deduction based on the mileage rate, and we've got a standard deduction of $10,380. So you can see that in this case, the standard mileage method actually gave you a bigger deduction of about $1,000. So again, sometimes it makes sense to run the numbers both ways, but if you just don't want to deal with all the extra work of keeping track of all of the expenses, you can just use the standard mileage rate. Just note that you may be shorting yourself a little bit of an extra deduction, but it may be worth it to you to not have the hassle factor of keeping track of everything. You do have to keep a mileage log, whether you use the actual expense method or the standard mileage method. So either way, you have to have a mileage log, so you don't eliminate that requirement. It's just that when you're using the actual expense method, you have to have a mileage log, and in addition to that, you have to keep track of all of your expenses. So again, more paperwork and things like that. And as we talk a little later about the SUV deduction, you actually get locked into using the actual expense method. So if you're trying to take that bigger deduction on a bigger car, you won't be able to use the standard mileage. So there's a couple times where we're doing tax planning, and that's not going to be an option. Okay, let me look at a couple questions here. If you lease an off-site office and have a separate office at home, can you deduct both? Sure. I mean, I, for example, have my law office, and I deduct the rent that I pay for the office space here at the law firm. And then I also have home office. I work from home. At tax season, I actually work from home a couple days from a week. And so I also deduct the home office at home. So sure, that's no problem at all. Self-directed IRA entity, is there a tax write-off for expenses? You can deduct expenses related to running the investment or the business inside the IRA. It's just you're not going to get a tax deduction outside the IRA for that, because everything that goes on in the IRA is going to stay in the IRA. So if you want to track that, you certainly could. But again, it won't give you a current tax benefit. Okay, and these are the different types of expenses, the actual expenses that you can write off. And then actually that should say 57.5 cents. It looks like there's a typo there. So just note that, or I'm sorry, nope, 57.5 cents was for 2015, and then it looks like it's going to go back down unless they adjust it back upwards for 2016. So again, if you're using the standard mileage method, these are the three things that you can take in addition to the standard mileage rate that are not included. So don't forget to give those to your tax person in addition to giving them the business miles driven if you're taking the standard mileage method, because we can actually add those three different categories on top of the standard mileage rate. So it gives you a little bit of an extra deduction there. Okay, and so in this case, obviously the automobile expense will give you an annual savings of about $5,500 in tax deductions for your vehicle. You could actually get a much bigger deduction than that with the deducting the SUV, which we're going to talk about in a little bit. I'll show you how to do that. So, okay, and then travel expenses. I actually encourage my clients to never get any personal trips, because if they're taking a personal trip, they're not getting a tax deduction. So, usually when I'm doing tax planning for my clients, I encourage them, if there's somewhere that they want to go, like if they want to go spend the weekend in Vegas, I usually say to them, well, is there a way that we can turn this trip into a business trip versus it being, you going for personal? If you're in real estate, do you have property there that you're visiting, or are you looking to buy property, or is there a seminar out there that you can go and attend and get some education? Is there a way that we can turn the trip into a business trip? And if the entire trip is for business, then you can deduct 100% of the travel expenses, and then you would also get a meal and entertainment deduction for and incidental expenses as well. So, again, not all of you want to take a trip and make it business, but because, you may want to just not have to deal with business while you're there, but certainly it's something to think about. And there are seminars all over the country that, you can attend that will enable you to take a business tax deduction on your trip. Some of my clients, ones that are in real estate, they may go buy rental properties in different states that they like to go to, or where they have family, where they know that they have to go there to visit family. And, while they're there, they will take care of the rental or visit the rental, and now they can deduct the trip. So there are creative ways to go ahead and do this. All of you should be thinking about that. But again, is for business, then all travel expenses are deductible. And so, for example, let's say that you decided to go to Las Vegas and you went from Friday to Monday. And let's say that Friday you had you traveled in on Friday via airplane, and there was a seminar on Friday, and then there was a seminar on Monday, and then you traveled back on Tuesday. Well, because the seminar was on Friday and Monday, and because Tuesday's a travel day, the intervening weekend would actually be considered to be business. You could actually be doing personal things on that weekend, but you still get those extra 2 days to be considered to be business because the seminar is spread out over a Friday and a Monday. So Friday, Saturday, Sunday, Monday, and Tuesday, and usually if the primary purpose of the trip is for business, the travel days will be included as business days too. So you could actually write off, the entire cost of the trip in that circumstance. Some days, you may have, on some trips, you may have 3 days spent on business and then 2 are just solely personal and no intervening weekend days. And so in that case, you may have to do a little bit of apportionment on the expenses. But again, you should be trying to spread it out as much as possible to get the best tax deduction. So these are some of the things that you can write off on your trip. Obviously, the travel, the airfare, the train, bus, car, the hotel and lodging, the taxis, the shuttles, the car rental, the tips, if you're tipping the bus person and all that, don't forget about that. The meals. So there is a 50% limitation on deducting meal and entertainment expense where you only get to write off 50% of the meal, but you will get to at least deduct the 50%. Your telephone charges, if there's internet charge at the hotel, laundry, dry cleaning, the tips, all of that would be a tax deduction. So don't forget to include all the incidental expenses, because every once in a while I'll be looking at taxes and I'll just see like the hotel and the airfare, and then the client forgot about all the other stuff that they spent money on, which can definitely add up with all the tips, and taxis and things like that. So don't forget about all those other out-of-pocket costs. Okay, and so there are a couple rules on deducting the travel. To be considered travel, you generally have to be away from your home, and you have to generally be somewhere where you need to sleep, so overnight, so in a hotel room, or somewhere where you've got to rest your head for a few hours. And because if you're just driving a couple hours away, you go meet with a client, and then you come back home that same day and drive back home, you're not really going to be considered to be in travel mode at that point. And so some of the things may not be deductible, like your meals in those cases. So generally overnight, for our purposes, I think that means sleeping at a hotel room, or sleeping in a different bed that's not your bed in your house would qualify. The IRS, again, I think I mentioned earlier, they love to audit the travel, meals and entertainment, and the mileage deductions. So make sure that you're keeping a good log or planner of what you did. If you're going to a convention or you have an educational seminar, for example, make sure that you are keeping like the daily agenda, or just something to prove that you were at the seminar and what the seminar was about, and what the timing was on the seminar. Because if 3 years passes and then you get audited, and then the IRS says, well, you spent 5 days in Hawaii for business, but you have no proof of why you went there, what you did, it's going to be really hard to come up with that. And try to contact the seminar company 3 years later and get a record of that. So keep good records for any educational or convention that you went to. If you went to visit your rental property, keep a log of that. If you went to meet a client, keep track of who you met with, what you talked about, what you did. So just keep that. You can keep it on your computer. You could keep it in a written daily planner. It doesn't really matter as long as you have the planner and you've got it written somewhere. Okay, so let me just look at a couple questions here. If the entire trip is not for business, but you take a seminar, how do you handle that? Well, if it's not entirely for business, you would actually just take a portion of the deduction. So if the primary purpose for the trip is business. So let's say that you go for 5 days and 3 of those days are for business, then you would be able to write off the travel to and from the seminar, and then you'd be able to write off the expenses on those 3 days. The other 2 days would not be included because those would be personal days. If the trip was primarily for personal, so let's say it's the reverse, you went for 5 days and 3 of those days were for personal, you would not be able to write off the travel, and then you'd only be able to write off the cost for the hotel and the meals in those 2 days. If the whole trip is for personal, you don't get to write off any of it. So you can see that the deduction goes down the more you spend the trip on personal. So definitely try to spread it out, like I said, so that you can at least get the percentage where the primary purpose of it is business. So at least you'll get the travel costs, which can make up a big portion of it, and then you'll also get the days, the hotel and the meals and entertainment on those days. If the trip is to Europe or a cruise, examples, contact me if you're going on a cruise and want to deduct that, because there are very, very specific rules for deducting cruises, and my clients are sometimes shocked when they go on a seminar on a cruise and they find out they can't deduct it because the cruise has to be registered in the U.S. and all the ports of call have to be in the U.S. on a cruise to deduct it. So 99% of the cruises out there are not going to have ports of call in the U.S. and they are not going to be a U.S. registered cruise ship. So there are ways to deduct the cruises, but we would have to talk about that. And then there are also special rules for foreign travel. I'm not going to get too into that, but I'll be happy to do that if you want to discuss that at a later time. So tips on meals, are they 100% deductible? No, the tip would be subject to the 50% because it is specifically related to the meal. So you would just take the whole expense, including the tip, and then deduct that for 50% for the 50% adjustment. Okay, and then to deduct the meal and entertainment expense, which again is a really high audit flag, and the IRS loves to audit this, so you want to be keeping a good summary or daily planner, you have to satisfy what we call the 5 W's. So in your planner or your log, this is what you want to be tracking. That way you won't run into any issues with the IRS questioning the deduction. So who is being entertained, name of the person, what you're doing. So did you go to a ball game, did you go to a concert, did you go to a Las Vegas show, what did you do? Where did it take place, when, and then very important is number 5, which says why. Why did you, how is there a business purpose? Are you taking this person out because you want them to invest in your business, or are they a client, or are you trying to go into like a real estate deal with them? What are you doing with this person? That's going to be really important for you to be able to satisfy the requirements with the IRS to prove that you have a business relationship with that person to be able to justify the meal and entertainment deduction. Again, if you're in travel status, you actually don't need to worry about the 5 W's. It's just enough that you're in travel status that you would be able to deduct your meal expense. But for entertainment, which is different from obviously for meals, you do have to keep track of these 5 different items. And then if you're taking somebody out to dinner, which would be under meals, but you're not in travel status. So let's just say you're in town and you take out Joe Smith during the week. You would have to document why you were taking that person out to lunch, or dinner, or whatever you're doing. So you would have to keep track of those. But again, if it's just you in travel status, you're traveling for business purposes, you actually don't need to keep track of as much here. So you would just have to show, if you went on a seminar or what have you, the agenda or what have you of why you're going to travel for business. Keep it in, again, you can keep it however you want. There's apps for these mileage expenses. There's probably an app for meals and entertainment and travel. You could keep it in an appointment book. You could just have a daily planner. It doesn't really matter as long as you could produce a written summary of what you did. In addition to that, you need to have a copy of the receipt. You have to have proof of payment of that receipt. So for example, if you are taking out, again, Joe Smith to lunch and you go to, a grill and you spend $100, not only do you need to document the 5 W's in your appointment book, but you also have to have a copy of the receipt showing, how much you spent. And then in addition to that, you have to have a copy of how you did that. So a canceled check would suffice. If you have it on a credit card, a copy of the credit card statement would be fine as well. The IRS wants a copy of those things if you get audited. Sometimes I'll go into audits and I ask my clients for receipts to back up some things. Sometimes they have the receipts, but sometimes they have none of the credit card statements if that's how they paid for the expense. And so we have to call the credit card company and get copies of all those things. Even worse, sometimes they don't have any of the receipts. Sometimes they'll just say, well, I put everything on my credit card. Well, credit card isn't going to say, it's not going to have a summary or enough information about what you did. And so the IRS is definitely going to want to get a copy of that receipt. So make sure that you're keeping those things. You generally need to keep copies of receipts for at least 3 years from the time that you filed the tax return. So that's the general rule. But don't throw away those receipts, because the canceled check and or the credit card statement is not going to be enough to prove what you did. So yeah, lots of documentation that the IRS is going to require. So these are some of the things that you can do if you are entertaining a business client. So tickets to sporting events, concerts, movies, golf, if your clients are into skiing, here in Colorado, we do a lot of skiing. And so, we can take business clients up there and write that off. Business parties, business meals, and drinks. So, again, look at some of these things, and I usually encourage my clients to have one of these categories in place versus giving what we call a business gift, because a business gift is actually subject to a very small limitation every year. If you go out and you want to repay a client for their business, for example, and you want to give them a gift card, you're only allowed to deduct $25 per year per person as a tax deduction. So if you give them a $100 gift card, the most that you can take as a tax deduction is $25. And so the tax deduction for business gifts is very small. And so I encourage my clients to look at other avenues for getting a much bigger tax deduction. And so taking them out to a business dinner in most cases is going to qualify as a much bigger tax deduction than just that $25. Even better, there are a couple categories of meal and entertainment expenses that will actually allow you to take 100% of the deductions, is that 50% deduction that I mentioned earlier. So where it says here business parties, if you have a catered event, let's say that you have a Christmas party and you rent out a space and invite all of your clients and business colleagues there, and you cater the party with food and drinks, you are not subject in that case to the 50%, actually take 100% of a write-off in that case. I have a client who has a New Year's Day party every year. She invites, she's a realtor, and she invites all of her clients and her business colleagues. She has phenomenal food and drinks. Everybody has a great time, and she gets to write off 100% of it. And that's a much better way to get a much better tax deduction than just, getting stuck with that $25 limitation that you may see. So there's also the other big 100% deduction is when, if you have employees and you bring in lunch into your office space and require the employees to be there to have like an office type staff meeting, you can also deduct 100% of the cost of the meals in that case. So the business parties, charity events would also be 100% deductible if you had to have food and things like that for that. So keep that in mind versus that $25 gift limitation. Okay, so let me go back to a couple questions here. How do you handle expenses for spouse when on a business trip? Well, if your spouse is not an employee or owner of the business, you're not going to be able to deduct their expenses. So what do? We want to look at making the spouse an employee or an owner of the company. So now not only can you deduct your own expenses, but you can deduct your spouse's expenses too. So we want to look at spousal employment as a way to increase the different tax deductions. So that's something to think about. Does the IRS ever talk to the client who was entertained? Yeah, they have. I mean, generally they're not going to talk to third parties, but if you were trying to deduct something that was huge, like, I don't know, it's just if you kept meeting with the same person and try to claim, these lavish dinners or something, they may want to talk to that person to verify. I mean, generally no, but again, if it looks kind of out of the reasonable type of expense, then they may want to talk to the client. They are allowed to talk to third parties. They can contact third parties as part of the audit process, so they're allowed to do that. But generally, no, unless the expense looks unreasonable. Is spouse always part of the business, regardless? Well, they're not always part of the business, obviously, unless you make them part of the business. So if you can put them to work, give them a legitimate part of helping you with your job, then you can make them an employee. You can make them an owner in some cases, and then you can start deducting their expenses as well. Is alcohol deductible, or do you exclude that? No, alcohol would be deductible. So if you are taking a business client out to dinner, you guys can order a few drinks, and that would be part of the meal deduction. Again, as I mentioned with the party, you could have alcohol at the party and get the 100% deduction. Yes, you can hold the party at your house as well. I've had, like I said, I had a client do that for her New Year's Day party every single year, and it's held at her house, and she gets to deduct 100% of that. Okay, so a couple more tests with the meals and entertainment. You have to meet one of the following two tests: the directly related test, or directly preceding or following a substantial and bona fide business discussion on the subject. So let's talk about those two things. So the directly related test means that you are going to dinner with the business client, and at the dinner you're talking about business. So that would be directly related. You're at the dinner, you're talking about business at the dinner, and in that case, you would be able to take that meal or entertainment as a business deduction. And again, you'd be subject to 50%, but it would qualify. But let's say that you're in Las Vegas with a client and you want to take them to a Vegas show. Well, it doesn't really make sense to be talking about business while you're trying to watch the show, right? So when are you going to talk about business? Because in order for it to be deductible, you have to talk about business at some point. So it either has to be right before the show starts or following a business discussion, and you could talk about it directly after as well. It just has to be directly before or directly after the event. So it can't be like 2 days later, for example, and then you try to relate it back to that entertainment. So just make sure, again, you're keeping track in your log about what you talked about. We went and sat down and in the lobby before the show started. We sat down and talked about business for 30 minutes before the show started, and then we went to the show, and then the entertainment expense would be considered deductible. Business associates will include your employees, agents, partners, accountants, attorney, insurance agent, business banker, supplier. I mean, any of those people can count as far as, deducting meal and entertainment expenses. You can take your employees on trips with you if it makes sense to take them to the convention, for example. We talked about hiring the spouse. In some cases, we have clients hire their kids. So all of that can all be included, and you can take a tax deduction for those parties. Okay, so the directly related test we briefly talked about. So again, you're going to be talking about the event, or talking about the business directly at the event versus before or after. And it's got to be a reasonable place to be able to talk. So again, you wouldn't be talking for the directly related test at, if you're at a nightclub, or if you're going to that Vegas show, you're not generally going to be talking directly during the event. So be careful with somebody who is an employee. And I just actually had a tax planning call with somebody, and their business consisted of husband and wife, and they were trying to deduct their lunches every single day while they were in town. So they weren't actually in travel status. Of course, they said that they were talking about business at every lunch, which I'm sure that they were talking about business. But the IRS would probably look at that as being pretty aggressive. So if you're trying to deduct a meal expense for your lunches every single day and it's made up of you and your spouse, you're probably going to run into issues if you got audited and the IRS looked at that. And if it becomes a situation where you're taking your employee or your contractor out and it's and there's no business purpose, then the employee may have to claim that as income because it's no longer a reasonable type business expense. It's just something that looks like, you're repaying them more for like a compensation basis. So you have to watch out for that as well. Okay, let me look at another question or two. Is networking deductible? Sure. I think networking is a perfect example of where if you're just, let's say that you had a person that you were trying to get business with, you took them out to dinner, but you didn't actually get any business out of it, it's still deductible because you still had a motive of trying to get business out of them. It just didn't pan out. So I think in that case, sure, the meals and entertainment would be definitely deductible. You don't have to get business out of it in order to call it a deductible business meal expense. You just have to have the motive of having incurred some business out of it. Husband and I are co-owners, and we hold an offsite quarterly meeting over dinner. Is that deductible? Yeah, I mean, again, I think if it's reasonable, you're not going to have to worry about it. It's like I said, those daily lunches that, aren't really, that get too aggressive where you're probably going to be, have a problem with. So quarterly, and some of the times if you have like a corporation, you have to have a board meeting and you can actually travel maybe to hold your board meeting, and that way you'd be able to deduct the travel costs, hotel, and the meals. Again, as long as it's not too aggressive, board meeting would usually be once a year, so you wouldn't be having board meetings generally every month. So yeah, I think that would be fine. Pigs get fat, hogs get butchered. True. Yeah, we want to be, we want to stay with reasonable limits on some of these deductions. There's a lot of things you can do, but yeah, if you start trying to deduct, everything under the sun that has no business relationship, you're going to get yourself into trouble. Okay, so I think I talked about holiday parties, picnics, annual events. They're fully deductible, no 50% limitation. So that's a really nice thing for you guys to all look at doing. So, if you're really looking to maximize deductions, look at having that annual like holiday party or event. Don't do the $25 gift. You may not even want to take, like your staff out to dinner and get the 50% deduction. You can have the holiday party instead and get the 100% deduction. Okay, so those of you who have children, I would highly recommend, as long as they fall within the age limits, to hire your children because it's a really great tax deduction. So the rule is that the child just needs to be at least 7 years of age. Why do we say 7 years? Because there was a court case that allowed a 7-year-old child to work, and so that's where we got that from. The child can be younger, I guess, if they're competent to do the work, but 7 years old we know is a safe age to start the child to work. It must be age-specific work, so again, you can't have the 7-year-old kid doing accounting work or financial planning in the business. So they generally can do things like office type work, cleaning, filing, admin type stuff. The pay must be reasonable. You're not going to pay them $50 an hour for doing filing. Make sure that you document what they're doing. And in a lot of cases, depending on what type of business entity structure that you are running, you may have to actually pay some employment taxes for them and put them onto the payroll. So make sure that for all of you who are looking at hiring your children, that if you have questions about it, make sure you get in touch with your tax person, because different types of entity structures have different rules. If you're running a corporation, you actually have to put them on payroll and pay employment taxes, whereas if you are running a sole proprietorship, a single member LLC, or a husband and wife partnership, you don't have to put them on payroll and pay any employment taxes. All that you'd have to do is issue a W-2. Just make sure you know about the different requirements for hiring your kids. But no matter how you look at it, it's a really great tax deduction for you. So the child is actually going to pay no income tax on the first $6,300 of their wages. And so if you're in the 30% tax bracket, and you get a tax deduction for paying them $6,300, and they pay zero income tax, you can see that you just saved almost $2,000 in tax by paying them. So definitely look at doing this. Here's an example of a tax savings situation with hiring the children. You've got 2 children, they work part-time. You pay each of them $5,000 per year. If you're in the 10% tax bracket, you save $1,000. If you're in the 35% tax bracket, you save $3,500. Even better, they can then take their earned income, and now they have some money where they can fund, they can fund a Roth IRA, they can fund a traditional IRA. I mean, they can fund retirement plans that can help them save for their college or whatever you want them to save for. So it's kind of a win-win for everybody. I would definitely encourage all of you to look at doing that. So let's see. Back to the spouse, would she need to be a W-2 employee, or how is employment recorded? You don't always have to have the owners and have a W-2. So if the spouse was an owner, the W-2 isn't always needed. But if you're running a corporation, then generally the owners and employees have to be paid with a W-2 and or employment taxes and employment tax forms. If the spouse is not an owner and just a straight employee, then yes, you would have to have a W-2 issued, and in some cases they have to have employment taxes paid and employment tax forms. So again, talk to your tax person, make sure that you're setting that up correctly. It depends on the circumstances of what type of business you are running. Can I deduct a portion of my kid's cell phones since I use it to communicate the work duties? Sure. If the kid has a cell phone and they're using it at 10% for business, go ahead and deduct 10% of their phone. That would be perfectly fine. Spousal employment, we talked about that a little bit earlier as well. I would encourage all of you to hire the spouses in addition to hiring your kids, because now you can start deducting all the spouses' things. Again, if you're traveling, you can deduct both of your expenses to go to conventions or look at properties or whatever you're doing. The spouse will have some earned income to fund retirement plans, things like that. So definitely a win-win. Okay, so based on all those examples, and again, we're just scratching the surface with deductions. I think actually I was going to talk about the auto deductions. I didn't put a slide up for that, but let me briefly talk about that, and then we'll wrap up. But again, we're just scratching the surface with some of these tax deductions here. Obviously we could sit here for hours and days and go through all of the different kinds of tax deductions. When we do tax planning at the firm, we do it more on an individualized basis because everybody has such different facts and circumstances. One client may have 3 kids they can hire, but then the next client doesn't have kids, and so we don't look at that. So we encourage our clients to come in a couple times a year for tax planning. The time you don't want to do it is at the end of the year. You don't want to come in on December 31st and say, I had a great year, now I want to get some tax planning in place. So it's really important to be doing tax planning all year round and not wait until the end of the year to get that in place. And so again, we're just, this was a short webinar, but there's lots of different things that can be included. I do want to mention the SUV deduction because I know I said that I would talk about that. So we were talking about the automobile deduction earlier, and there is a special tax deduction for any type of vehicle that you purchase. So it's a purchase, not a lease. You'd have to purchase it that weighs over 6,000 pounds. And so if you, let's just say hypothetically, you went out and bought an SUV that weighs over 6,000 pounds and the cost was 50 grand. You can finance the car so you don't have to pay cash, or, you don't actually have to put any money into it. You could finance the whole thing, and you get a special tax deduction. It would be a $25,000 deduction off the initial cost of the vehicle that you can just take right off the top. There's also something called bonus depreciation that is in place for 2015 and 16, where in addition to that 25 grand, you can deduct another 50% of the remaining cost of the car after the 25,000 is taken. The bonus depreciation is only available for brand new vehicles. So if you purchase a used vehicle, you can take the $25,000 deduction. You just don't get the extra bonus. Then in addition to that, you would get first year's depreciation on the remaining cost, and you get all of your out-of-pocket operating expenses for gas and insurance and everything else. So you could easily go out and buy a $50,000 SUV that weighs over 6,000 pounds and write off 40 grand in the first year. We do that quite a bit for clients who are maybe having a really big income year and they need, some bigger tax deductions. We look at the vehicle deduction many times to, help them with some tax savings. So, and just keep in mind that the deduction goes down as business use goes down. So if you're only using the car 60% for business, you're only going to get 60% of that $25,000 deduction. You won't get the whole thing. So keep your, business usage up on the car up over 50% and keep it as close to 100% as possible. So it's a great tax incentive to get that SUV deduction. And then in that case, again, you would not be using that standard mileage method. You'd be using the actual method on if you want to take that SUV deduction. Okay, so I'll answer a few more questions, and this is our contact information. So those of you who are not current clients, or those of you who are, if there was anything that I missed or didn't get to on the questions, feel free to shoot me an email. My email is down there at the bottom. You can always schedule a time to talk about anything that we went through today that, and again, didn't get answered. So these are some of the practice areas that we do here. We are tax attorneys, but we do a fair share of tax preparation in all 50 states. So that's a pretty big part of what we do at the firm as well. And then I did put a tax savings coupon here. This will be for new clients, unfortunately. Sorry, current clients, but new clients, you would get a 20% discount on the cost of services for the first year if you do become a client of ours. A lot of times I get asked the question, well, you're tax attorneys, so that's just kind of right away we think your prices are going to be way higher than like a CPA firm, but generally not. I mean, we wouldn't have any clients if we outpriced ourselves out of the market. If you want a free estimate about how much it would cost to prepare your taxes or do planning, just give us a call. We will be happy to give you a free estimate of cost, and you can, determine whether or not that is a good fit for you. So that'll wrap it up. I am going to stay on just for a couple more minutes and go through some of these last questions. And thank you guys all so much for attending the webinar. Thank you, Ameda, for setting this up and having me. And after we get through tax season, I hope to do actually more of these webinars more often, just because we always want to keep you guys educated with the different things and all the changes. The more information that you guys have, the better off we all are, more tax savings you're going to have. And so it's definitely something that we like to have in the firm. All right.
Yeah, Stephanie, please answer more questions. Seems like, we still have a lot of questions floating in. And I got to say, I made a mistake of never asked you guys how much you're going to charge me, but I did ask Scott and you, how much are you going to save me? And I was hooked. I was like, okay, if this is how much you're going to save me, I don't care how much you charge me. So I just rather pay you guys and then paying the IRS. And when I got the bill, honestly, I thought you guys made a mistake. I really thought you guys made a mistake. You probably missed out something because it's less than what I would totally expect it. You guys, attorney, your wealth of information. You do asset protection, gave us great guidance of how we can shelter more money into our wealth than paying to the IRS. So that alone, you guys, I'm not asking you to raise your price. Please don't. But I am saying you guys are more than reasonable, much, much less than I thought you would charge me. I have actually asked another firm, I think they're in Arizona, up front, guess how much they want? They want us to pay $11,000, and basically they look at your assets and your income and say, oh, we need this much, and I thought you must be kidding me. So I mean, I'm sticking with you guys. It's been over 10 years. You guys are great, and I'm sure you cannot go wrong with Stephanie and her firm. We have excellent experience. So, but anyway, I'll let you get back to your answering question. I'm sure these folks here, have lots of questions for you.
Yeah, thank you. Yeah, and a couple people I don't know if everybody can see the chat thing. I think you guys can, but a couple people are saying, you pay less here than prior CPA, and you're not paying any more. So, I mean, we're definitely going to be more than like an H&R Block type of place, but I think for most of the people, you're going to need a more sophisticated tax person to do your taxes anyway. So you're not, like an H&R Block, because they may not be able to handle the complexity of what you have. So yeah, I usually don't get comments that we're any more than any other professional CPA firm. So that's not something I think you guys would need to worry about. I think there was a question about the mileage rates for medical and volunteers. So the automobile rate for 2015 anyway, I mentioned, was 57.5 cents per mile. There are different rates for different things. So charity for 2015 is 14 cents per mile. And then, 2015, 14 cents per mile. And 2016, it's also 14 cents per mile. Medical for 2015 is 23 cents per mile. And then for 2016, it's 19 cents per mile. So it's weird that the mileage rate went down to 54 cents per mile, but I guess they don't think we're hitting much inflation. So that's why that's gone down. So I think I had a question about that. Could I deduct a portion? Let's see. Oh, I'm sorry. Does percentage principal also apply to calculating cell phone costs when phone is used for both personal and business? Yeah, I mean, I think on the cell phone, for example, you would definitely have to apportion the deduction for business and personal, because unless you just had one, if you have two cell phones, one's personal, one's business, then you deduct the business line 100%. But if you're using it for both, you will need to assign some kind of a ratio. IRS, again, they're not going to question that too much. So if you get like 80% business or something, I mean, it's usually not that high of a deduction that they really go crazy with that. But you do want to at least take off some of it for the personal section, just because they will look at that. So, thank you guys for all the nice comments that you're leaving. I really appreciate that. We don't always get to hear things. People, if they complain about things, it seems like you hear that more, right? Luckily, we don't get that many complaints, but sometimes we don't always hear about the compliments. So I really appreciate you guys about saying that. We can assist you if you live out of state. We actually have a lot of clients that are out of state. We do taxes in all 50 states, and if you are in a different state, just give me a call. You can set up a free initial consult, and I will go over how that works. But we can definitely do things remotely. Some of the clients who are here in town, they actually don't come in because they're too busy. So we we e-file everything. We have online client portals now, e-organizers. Everything can be done electronically, so that's not a problem if you are in the market for looking for somebody else. So I think I've answered all the questions. If I haven't, like I said, shoot me an email. We did record this, so you will have, I don't know, Amita, if you want to explain how they have access to the recording, but if you need to refer back to it, you certainly can.
Great. So, anyone who is not currently with Stephanie, I'm sure, you have lots of biggest fans here. They already talk about, how much you save them. Tons of people saying, okay, one trippy said, you saved them $285,000. Yes, this is amazing. So please, feel free to contact Stephanie here, and you get 20% off, for her years of the new service if you're a new client. And I promise you one thing, okay? I promise you one thing. Not all tax advisors created equal. So, and you'll be amazed, how many crazy CPAs out there, make up these tax fictions that don't exist, or they have no idea what they're talking about. So at least interview a few of them and make your educated decision there. Does it sound fair, Stephanie, right?
Yeah, absolutely.
Yep. So I have to say, I have to bring you back at some point, and we're going to have to, I guess, take a consensus, what other topics, that people might be, or our, fans here, love to hear from you about, because, you're just full of information. And right, everybody?
Yeah, I just, I don't know how they could probably email you or email me. Let me know what topics you guys want to hear.
Yeah, absolutely.
Again, after we get through tax season, I'll do some more. Peter McFarland, who a lot of you guys know, he's another attorney for the firm. He does a lot of webinars as well, so we'll bring him on board too, and have some more topics.
Oh, that would be great. That would be excellent.
Okay, I see a couple comments, so I'll make some notes.
So I'll yeah.
I just see a couple
I've been doing
comments about
okay.
topics. I'll make some notes. So we can definitely do what happens during an audit. So okay.
Yeah, that would be great. We definitely prepare that. Well, thanks everybody. Thanks for your time. I'm sure you guys have a busy day and taking care of your business. And thanks Stephanie especially. Very busy, ready for tax season. And we have to do this again.
Hey Buffeteers, don't forget to subscribe, share, review, and give us some 5 stars love. And as always, Startup Buffet. Your business, your way. Get all the extras, downloads, and videos mentioned in this episode at startupbuffet.com/.